Hi there, today is the 24th. We are wrapping up our course. I'm picking up from where we left off in Chapter 7. I'm right around page 165. And I listed for 7 companies here their beta characteristic, okay, their beta coefficient. And please keep in mind that the companies that have a beta of less than 1, which are Pepsi, Pfizer, McDonald's, and Exxon, are less volatile and therefore less risky, beta being a measurement of risk. The ones that are greater than 1, GE, Ford, and Google, at least at this writing, are viewed as being more volatile and therefore more risky. Okay, so stocks with a low beta are stocks that would be included in a portfolio of a person who is more averse to risk. Okay, having said that, let me see if I missed anything here. Remember, now, I showed you a lecture ago that we can diversify away a certain amount of risk through adding more stocks to our portfolio, okay? But we can't go below the line of market risk. However, beta allows us to understand that market risk, and that's why it's so important to us, okay? Because we can control everything that was above that diversifiable risk blue line, I think it was blue, in our graph. Let's go back to that and make sure. And there it is, yes, blue. And so up here we can diversify a certain amount of risk by spreading our money around through different stocks. Anything in the non-diversifiable area below that blue line and above the y-axis is something that you can't really control, but you can understand, and by your understanding you can select stocks that will minimize the volatility that the market as a whole will bring. Okay? So, here's a graph. Remember, beta can change. Beta is not static. Okay? So these are terms we will use in analyzing beta. And what we base upon beta, something broader called the CAPM, Capital Asset Pricing Model. This is a wrap up to the chapter, so we're on the home stretch, ladies and gentlemen. This is how beta looks if you graph it out. Now, what you do is you draw essentially a y-axis that has the return on your stock. Remember, beta is not measuring a stock's price, it's measuring a stock's return, okay? So, we look at how that return fluctuates for one stock, that's your stock. Now, on the x-axis, the horizontal axis, we're measuring the overall return on the market, that is a portfolio containing every stock in the New York Stock Exchange or any index that you prefer. Okay, now, let's look at a beta of exactly 1 that's noted on this graph by a blue line. So that means if the market's return goes up 10% on the x-axis, then on the y-axis your stock will follow, it will go up 10% as well. So that blue line has a perfect 45-degree angle on this graph. Okay, now I went back to a list of 7 stocks and I picked out Ford and Pfizer. Okay, now Ford had a beta that was greater than 1. It was 1.41. If I graph that, you'll notice it's on the red line here, okay? So if the market were to go up 10%, we would expect that Ford would go up 14.1%. It's beta times the 10% market increase. So you can see that that's pretty much where it is, okay? That's the slope of the red line. Now that can work downward as well. If the market were to drop 10%, then we can expect that Ford would drop about 15% as well. Okay, so up or down, the return on your stock versus the return on the market is charted by beta, either mathematically or, as you can see in this case, visually. All right, now finally we'll attack Pfizer. That's got a beta of 0.69. It is safer. It's not as volatile as the market's return. So if the market's return goes up, Pfizer will follow it up, but not to as broad a degree. So if the market return goes up by 10%, Pfizer will go up to about 7%, okay? About 70% of the market's return. Okay, so the slope is shallower. That, in a graphic sense, is how beta works and how beta is charted, okay? Please study that. I will not ask you to draw lines for me, but I will need you to know what beta is, how the beta coefficient operates. Okay? All right, now, beta is one of the components of what's called the CAPM, the Capital Asset Pricing Model. There's a little blurb on page 164 about what it is. A very brilliant man named Harry Markowitz, I believe was his name, along with a couple of other gentlemen, won a Nobel Prize by defining the capital asset pricing model. It is hugely complicated, and a graduate course, I dare say a doctoral course, just on that one model could be taught. But one beautiful takeaway from the CAPM, the capital asset pricing model, is that you can essentially analyze the risk-adjusted rate of return on a stock that you require for the amount of risk involved, based on two things. Based on the return you expect from the market as a whole. We always come back to that, don't we? The rate of return on the market as a whole. With bonds, we called it the required rate of return, okay? We revisited that in stocks. Okay, now we're looking at the stock market as a whole and saying, if I invested in an ideal portfolio of one share of every stock in the market, what return would I expect? We're going to call that R sub M. Okay? R sub RF, you already know, is the risk-free rate. That is the rate of return on a U.S. T-bill, a short-term instrument of the U.S. money market. We know what B is now, the beta coefficient. That's the capital letter Greek B, beta. Okay? And that's the beta of the stock you're considering. And finally, K sub S is what we'll be solving for. That is the risk-adjusted rate of return on a stock you're considering. S is the stock you want. Okay, so you want to be able to say, if I invest in this stock, what rate of return must I require? Now, the capital asset pricing model tells us so many things, but this is the one that's most pertinent, the one that resonates with you and with me the most as individual investors and as students in a beginning finance course. Okay? All right, remember that we built interest rates on levels of risk, and the capital asset pricing model does the same thing. The rate of return on a stock begins with a risk-free rate. Okay? There's some rate up here that stock must earn. How do we quantify that? Well, we're going to start with the risk-free rate. You can invest in a nice, safe treasury, right? So we're going to start with that treasury and then stack something on top of that based on how risky that stock is compared to the market. Okay? So K sub S is what we will solve for. We do it by saying, take the rate on a treasury bill, the risk-free rate, and then add a premium based on the risk of that stock. Okay? So let's forget about the T-bill. We already know that one for a minute. The risk premium is there. It's the difference between the risk of the overall market and the T-bill. There's a difference, okay? Here's the T-bill. Here's the market as a whole, okay? So we're going to break out that T-bill and just focus on the excess, the premium that has to induce us to invest in the market instead of a T-bill, okay? But here's where your stock comes in. Up until now, we've talked about the market. Now, we're going to take that difference, just that difference, the excess of the return on the market over the return on a T-bill, and multiply it by your stock's beta. Okay? Those are all the factors you need. Now, that risk premium is the result. Now we bring the T-bill rate back in, add that premium to it, and now you've got the K sub S. Now this looks complicated, but it's really, really easy, okay? So we're solving for K sub S, the risk-adjusted rate of return that you should make on a stock, okay? That's going to be the result of taking R sub RF, the rate on a T-bill, plus the excess of the market return over the T-bill return times beta. Remember your order of operations, friends. Solve what's in the parens first, then multiply by beta, then take that whole result, add it back to the T-bill rate, the risk-free rate, and there you have it. Okay? This is all laid out for you on pages 166 and 167. Okay? All right, let's go on. All right, here's an example. Let's assume the T-bill rate is 3%. The expected rate of return on the market is 11%. and the beta of a stock that you are considering is 0.75. Okay, now let's stop right there. Okay? The beta of your stock is not as risky as the market. All right. Now, I want you to look at the market return. It's 11%. If a stock you're considering is not as risky as the market, then you know that you're going to get a result less than 11%. So there's a little check for you. All right? You can intuitively, you know that you're going to be expecting a rate of return less than 11%. Why? Because your stock is not as risky as the market. So by substituting all of those factors, the risk-free rate of a T-bill is 0.03. We add the premium. That premium is the excess of the market over a T-bill, 11% minus 3%, right? Take that difference, multiply it by the beta of your stock, that's 0.75. Add it back to the T-bill, and there it is. K sub S is 9%. Interpretation. It means for this stock, which is not as risky as the market, which demands 11% for you to enter it, to buy this one stock, it would have to pay you, to the best of your belief, 9% based on its risk. Okay? All right, now let's look at a stock with a beta of 1.1. Now, go no further at this point. We know if the stock's beta is 1.1, it's riskier, it's more volatile, therefore riskier than the market. So if the market is 11%, we kept that data the same, that means that when you solve for this equation, you'd better get something greater than 11% or you made a mistake. So intuitively, we can almost check ourselves. By substitution, K sub S will be equal to 0.03, the T-bill rate, plus the excess of the market return over the T-bill return, 11 minus 3, 11% minus 3%, times your stock's beta, that's 1.1, math it all out, and your K sub S to induce you to invest in this stock and its attendant risk is 11.8. Sure enough, it's greater than 11% as we expected. What does it mean? It means that because of this stock's higher beta, it's more volatile, and there's a greater tendency for it to fluctuate over what the market is doing. If your stock's beta is less than 1, then it will fluctuate along with the market, but not to as great a degree. Remember, less than 1, less volatile. Greater than 1, more volatile. And with more volatility comes more risk, and therefore you expect a greater rate of return to compensate you for that risk. Okay? What if your stock has a beta of 1? Exactly, it follows the market in lockstep. Well, that's easy, really. Think about it. If you multiply anything by 1, you get the number itself, correct? So if you take 0.03, the T-bill return, and you take the excess of the market of 11% over that T-bill rate of 3, and take that difference of 0.08, multiply it by 1, it's still 0.08, add it back to 3%, and you get 11%. So there's proof that your stock with a beta of 1 follows the market exactly. Very good. The final topic that we will discuss is called the SML, and I'm going to stop here, and I'm going to save that for our next to last video lecture, okay? I'll cover the SML as our final topic in Chapter 7, and then I'll record a special video to solve the problems I will assign at the end of this chapter. Stand by, I'll be back with more.